Hello and welcome to another episode of The Wannabe Entrepreneur, the podcast about what's really like to bootstrap a company. My name is Thiago and I've been a full-time indie hacker for the past 2 years. And at first, my main goal was to actually create something that would pay the bills. And after about 1 year and a half, I did. My co-founder and I created PodSqueeze that is now paying our salaries, which is great, but I never really thought about what would come next. What are the next steps? And actually, an exit is a real possibility, selling your project. And I've met a lot of other bootstrappers, other makers that were able to sell their project even before making any revenue. There's a lot to be said about selling and acquiring startups, but I don't know much about it. I only know that there's a number thrown around, which is 10x. You can just multiply your ARR by 10, and that's it. That's the number that people will buy your startup for. Well, I always thought that number was a bit outrageous, out of this world. It makes no sense that someone just 10x your ARR. And that's actually true. There's a lot of different nuances in the world of actually selling your project. And today I have an expert in this. He's the founder of MicroAcquire, which is now acquire.com, and his name is Andrew Gazdecki. He has this website where you can list your startup or your project and it will help you find a buyer. He has sold many, or at least helped sell many projects, indie projects, startups. And yes, today I have him here in the podcast and it was great because I got to ask all the questions I had. So in this conversation, you will learn more about his projects, the ones that did not went well and the ones that didn't, and everything he has learned from it. And of course, everything that there's to know about the world of selling startups. Hopefully, after this, you will have a better understanding on how much you can expect buyers will give for your project. And last but not least, we'll be also speaking about branding. You know, Andrew Gazdecki is an expert in marketing. He has done really cool stuff on Twitter. If you haven't seen it, just go to his profile. And I have this question, which is, how much should one invest in brand awareness, in this kind of marketing techniques that do not bring customers right away? How do you measure that? Those are all the topics that will be covered in this conversation. So without any further ado, here's Andrew. We are live with Andrew Gazdecki. Did I say your name correctly?
You did. Gazdecki.
Nice. Tell me about this name. Like, where is it coming from?
It's Polish.
Polish. So your background, do you speak Polish?
No. So fun fact about myself, I actually have never met another Gazdecki in my life. I don't know my dad's side too well, but I actually someone else told me I was Polish, but if you ask like a Polish person, they'll say it's pronounced Gazdecki. That's all I know.
Like I have some friends from Poland. I have to say it's so hard to say their names. It's so hard. But I find it funny because a lot of people ask you this. I was just like listening to an interview you did in the My First Million podcast, and I think that was one of the first questions, like how to say your name.
Yeah, growing up, it was the common ones are Gazdecki, Gazdecki. And then when I was growing up too in elementary school, like when a substitute teacher would come in, my first name, the W cuts off. So it'd be like, Andre, is Andre here? And I'd be like, God damn it, it's a substitute teacher. So I'm used to it.
You grew up in the US, right?
Correct. I was born in Detroit and then I grew up in a small beach town called San Clemente in Southern California.
Okay. And were you like born in a family of entrepreneurs? Like, tell me a little bit about your entrepreneurial background. Like, where did this eagerness for entrepreneurship and building companies started from?
Yeah, good question. So to answer your question, no, I didn't have really any sort of like entrepreneurs in my family. I would say I kind of got an entrepreneurship by my environment in San Clemente. San Clemente is like a beautiful beach town full of rich kids, and I was kind of like the poor kid at school.
Okay.
Awesome awesome place to grow up. But early on, I mean, I just hung out with a lot of kids that had, very wealthy parents. My parents, never graduated college. And so, you go to these big houses and stuff and see these nice cars. And I always would ask, like, how do you get that? Like, like, why do you have that? And so, money became like it was very front of mind, I guess you could say. And, I was kind of that kid who learned early on that, okay, to get this stuff, like, you got to start a business. And so I started, multiple businesses as a kid, like at an eBay store when I was 13. My thing was I would find misspellings. This is embarrassing, but I'll share it with you. Specifically, Beanie Babies. Beanie Babies were big. So like any sort of misspelling of a rare Beanie Baby, I'd buy it and then I'd list it with the correct name and get some arbitrage on it. What was the other thing? I think it was
super
like
smart.
EverQuest characters, EverQuest, the super nerdiest stuff you could think of. And then I would make websites for like all the bands at my high school. That was fun. And then I got into photography, so I'd get like free access to like rock shows and stuff, which was fun. But that's when cool. I look back on it, I did it mostly out of just necessity. Like if I wanted a new skateboard, I had to go buy one, and my parents didn't have money, so I had to go figure out how to get money myself. And then I really just kind of fell in love with all of it. Just learning businesses, like, when you get that first sale, you get kind of a rush. And so I knew pretty early that was a game I wanted to play. So
that's
just kept playing it.
I'm now reading a book called, was it like Rich Dad, Poor Dad? Do you know this book?
Yeah, I've never read it, but I probably should. That's like a book. Those movies where you say you've never seen it, and they're like, "You've never seen that movie?" Exactly. It's like one of those books for me.
Yeah, exactly. I mean, I've the author popped up on my YouTube feed a couple of times, and then I got gifted the book, and it's funny because it somehow remembers me of the story you're telling. So the story is that the guy, like the author, when he was a kid, he had his real dad was like a graduate, like a professor, but he was doing, as he calls, the rat race, so working for others all of his life, always quote unquote poor. And then he met this other guy, which was an entrepreneur that taught him all about financial literacy and so on. And my question here is that, okay, I understand all of your friends were like richer and they had like good things and you wanted that. But then you said that the only way you saw to reach that was to start a business. And that's interesting because it could be, okay, maybe I would just get a job. So why, not getting a job? Why did you get any kind of mentor or someone that would tell you, no, like if you really want money, you need to start your own thing?
Yeah, I would just ask my friends' parents. I'd be like, what do you do? Like one of my friends' parents, he owned Circa Footwear, Special Blend, some other like snowboard brands. Circa Footwear back in the day was the shoe that they had, like Chad Muska if you skate. One of my friends, his dad owned like I believe it was like some home theater company. One of my other friends' parents owned a real estate development company that would build like big track homes. So they were doing big stuff. And I would always ask my friends' parents, and they're like, dude, why? Even on like LinkedIn today, I got one specific friend whose dad always still like, because he's seen my career progress and stuff like that. In high school, I would go to my buddy's house and then I'd be like, hey, is your dad home? I just want to like chat it up with him. And so he'd tell me, yeah, I was just curious. It wasn't like hey, how do I do all? It was just like, hey, I'm like really into you build track homes. Okay, so how does that work? How long does it take? And it was just natural curiosity. But so that kind of put the light bulb like, okay, all these people are building businesses. That's what I need to be doing. And then if you just do the math on, if you want to become a millionaire, and frankly, that kind of was my goal in the beginning. Because being poor sucks. Like there's no other way to put it. And let's say you make 200K a year, you don't spend anything, you really take home 100K. So that's basically if you're not spending literally
Mm.
anything, and you had to save that for, you know, 15 years, assuming you have rent and you have food. And so the time just doesn't add up. And so it became pretty apparent that, you need to build an asset and then sell that asset. And then, the second way to create wealth, which I think the book you're referring to talks about, is you buy assets as investments to grow.
Exactly. Yeah. He speaks a lot about buying assets instead of liabilities, and kind of gives me a little bit a perspective on how, we just don't learn enough about financial literacy, and how like our society is made for you to spend money and not really to build money, to build wealth. And like, how was your relationship then with your parents? Like, would you try to come home and explain to them? Did you see right away that they were maybe making some mistakes in terms of how they were managing their money?
I mean, I was so young. I mean, it's hard to really be like a financial advisor to your parents.
Yeah.
You know what I mean? Like, hey, like,
course.
go to this. But they were just doing the best they could, that's kind of where I'd leave it. Is they worked hard, they just didn't have the best. Like, my mom had me when I was 20. I have an older brother.
Okay.
And so when you're put in a situation like that, young kids, like, so early, it's just so hard to, find a way out. So they did the best they absolutely could.
Do you think it's possible for anyone starting in a poor family to become rich?
Yeah.
You think that, I don't know, this is a common argument, right? Like, a lot of people say, no, you need to be raised with the right background. And I don't know. I'm just wondering if if wealth is really available for everyone.
It is.
You think so?
The way I kind of think about it is, there's a lot of like survivorship bias of like, oh, I made it. And, I think maybe that's kind of the crowd I'm in, but I didn't come from too much. But the one thing I didn't do was make a bunch of excuses and say, I need this, I need that, and like, I think the main thing I understand is there's other people who have been in your situation and worse situations and have figured it out. So like, it's not impossible. So it actually kind of bugs me when people are like, I need rich parents, I need like investors, I need like this, I need like that, I need a mentor, I need blah blah, like whatever it is. It's like, you can go out and find those things if you just take action, stop making excuses. But I mean, I wish I had a trust fund, rich parents. I'm not gonna lie, like, it'd be more helpful.
Do you think it's a superpower for you to come from, I guess, a poorer family without that background money? Did this give you like certain amount of skills that perhaps your richer friends wouldn't have?
I mean, when you go through different hardships in life, it definitely ingrains something in your personality. And a big part of entrepreneurship, I truly believe, is mental. What I mean by that is, when you're running a startup, especially as your team grows and you're the CEO of the business, the job can kind of suck. And what I mean by that is, you don't ever really get a chance to focus on the good stuff, because there's no real point in focusing on the good stuff. So you're constantly being pulled into the biggest problem, the weakest link on your team, the biggest problem in your sales process, or the biggest strategy decisions that you have a 50-50 chance being right. But the flip side to that is, when you've kind of gone through some diversity and overcome some other challenges, you just are kind of used to it. I always say, there's a Tupac quote, but after every dark night comes a brighter day. But it kind of lends a thought of every problem. Shake it off and like stop feeling sorry for yourself. But every problem has a solution. I think when you enjoy solving problems, and when you've kind of had to overcome certain things in life, whether that's growing up or through college, or it could be later in life, there's no specific time frame in my opinion. But it builds that mental muscle of, yeah, shit's going to go wrong, and you got to be comfortable,
Yeah,
in those situations, be calm and be able to think clearly. But then most importantly,
that's a
I
good
always say
point.
you got to learn
Yeah.
to love it when it sucks as well, because when you enjoy even the bad times, I think that's what the big separator between entrepreneurs is,
Mhm.
because when it gets super hard, that's when a lot of entrepreneurs quit. And,
And a lot of
that's,
others love it. They just love it. And
yeah,
I when it gets hard, I love it. I was like, okay, that's a challenge. Let's fix it.
yeah, like for me personally, when I go through business problems, issues, everybody has them. And I've made a billion mistakes too. So I've made probably
Mhm.
every mistake you can list. But I like to just work the problem. That's kind of that's my
Mhm.
stress reliever. It's not going to the gym. It's not taking an ice bath. It's not, like it's literally, what's the problem? What are the options? Okay, let's go. So
Yeah.
like, I guess
I
bias for action
yeah.
also is kind of a trait that comes out.
When I started my journey as an entrepreneur, I was looking for a recipe. I was like, okay, there's a lot of people that are succeeding. Probably there's a recipe, a bunch of actions we can take that will lead to success. And what I've realized in the end is that no, like everyone is figuring out, and every situation is different. Every company, every business is different. And the kind of common denominator between all of this is that people just did trial and error. They learned from their mistakes. They tried something, they analyzed it, they saw if it worked or not, and then they adapted enough until that somehow they found a gold, or they found the success.
Yeah, I think one thing that's a really great point. I think if you pull back the curtain too, and a lot of like entrepreneurs you might look up to, or ones that are like killing it or whatever,
Mm.
behind all that is a ton of failure. It's a bunch of dumb businesses
Oh
made.
yeah.
It's a bunch of,
Oh yeah. Yeah.
lessons learned. Like if I had to give you a framework on how to become a successful entrepreneur, I'd just say, here's the ball, just keep shooting it, because
Yeah.
you'll get a little better, but you need to do it like daily, and like learn to love that process, and then learn to
Hmm.
love like when you lose, and then learn something from it. It's an
Yeah.
iterative process. And then another point to make too is, I think a lot of people, I always say entrepreneurship is a game of grit and perseverance, not intelligence. Because if you
Mm.
overthink stuff, like you're going to start a business, your chances of success are so low. So if you get all analytical about it, and like, have like a 50-page business plan, you'll probably just talk yourself out of it. There was a
Mm.
recent conversation with the founder of Nvidia, and he
Mm.
literally said, if he could go back 30 years, what would he do differently? He said he wouldn't start the company because how hard the journey was. So I think
Ah,
there's, a
okay.
level of naivety that entrepreneurs need,
Oh
kind of like
yeah.
a blind belief to succeed.
Yeah, definitely. Uh, one thing that I've noticed, so I've been failing a lot, and recently, my co-founder and I, we found success with our startup, Bootstrapped startup, and it was completely different. So from the moment we started like sharing it with the world, we saw when we got some traction, as we have never seen this traction before. We started many businesses in the past, and like we never seen this. And I guess that was the first time, after 10 years of like trying this out, that I found what is called product market fit. And it was it's a different game from when you go from trying, hustling, and then product market fit, and actually getting money in and seeing people like lining up to use your product. It's a different stage of being a business person. And I started learning a lot of new things that I haven't learned before. Um, and I wanted to ask you, like, do you remember the first time a product of yours uh, got this product market fit that you found, well, like this is different from, maybe selling things on eBay. Like this is growing. This is like a life of its own.
Oh yeah. When you find product market fit, like there's definitely moments where you're like, holy shit, like this
Yeah.
is growing fast, way faster than you expected. Um, and it's rare. And when it happens, enjoy those moments, because it's definitely an adrenaline rush that's hard to
Oh yeah.
explain.
Hmm.
Like with my first company, or not my first company, let's just call my first real company. The first company I actually like incorporated. We found product market fit maybe like a year in, pretty strong. I had built like a really bad prototype with a developer because I'm not technical, and what I would do is it was it was the ugliest page. Only I knew how to do it, but what I could do is basically customize a mobile app through a web interface. And at one point, we struck a partnership with this agency in Switzerland because they were using the template thing. Like he figured out how to use it somehow.
Okay.
And he was making these apps for these big hotels in like France, Germany, and their Ramada hotels. But my point being is, I asked him, how I could help him sell more of these mobile apps. And this is in like 2010 when the iPhone just came out.
Okay.
I remember asking him, how I could help him sell more mobile apps. And he brought up this distribution strategy of white labeling our software so he could put his branding on it, which would allow him to charge his own pricing. And he could bundle it in with his, social media marketing and web design marketing packages that he was doing. And once that happened, we just went boom, just straight. I remember because I asked him, I was like, well, we didn't have the functionality. So, and we're just in like a room like this big, and there's like two of my buddies next to me. And I just said, will you pre-subscribe to like 50 mobile apps, like upfront yearly payment? Just kind of was like throwing a Hail Mary. Yeah. And he did. And so right there, just our growth chart went like that. And then immediately from there, we obviously started, instead of selling to small businesses, we started selling to agencies. And that basically, we went from selling one mobile app like after 10 calls to selling packages of like 30 in a one call close. And it was wild. And
that is crazy.
Yeah, that was the right place, right time business. But yeah.
So you had already the product. The only thing that you didn't properly have was the target customer, or like the way you packaged it. And once that changed, it changed the whole business.
Yeah, because our initial go-to-market was we were cold calling restaurants. And so when you cold call a restaurant, it's super, super difficult because you're trying to find the owner of the business, the decision maker. And then we were selling apps, so mobile apps. So when we would call, they would be like, you want our appetizer menu? Like, what are you talking about? And then really the way small business owners buy is, there's a high level of trust that's required because they only have typically a SMB. I'm sure it's higher now, but the number was SMBs will spend around like 500 to 1,000 a year on marketing, and that's it. And so a mobile app will cost like $50 to $100 a month. So we're taking that whole budget. And the best way to get to them is through pre-existing relationships. So by white labeling our product, when we would call web agencies, we would have a much bigger value proposition because for a restaurant, they're like, I don't get it. I don't need that. Like people are going to come in and eat my food without your product.
Exactly.
But for
they don't know you, right? Yeah, as well.
Yeah. For a web design agency though, we had the value proposition of, hey, are any of your clients asking about mobile applications, or do you plan on offering mobile app development at your agency? Because, and then we'd have some stat that was like, this was like our sales process that I made. Because we've read like, new customers are, 57% more likely to work with you if you have all the services they're going to need. And they're like, yeah, we're thinking about it. And then we'd ask, well, are you going to hire a mobile developer? And they're like, no. And we're like, well, would you be interested in like a full out of the box custom solution where we handle the tech, you handle the sales? And then they were like, interesting. How does that work? And then we would sign up agencies like clockwork because they had the problem. They had an existing book of business. And then we gave them a new product to sell their customers. And they could bundle it or they could sell it individually.
What is the name of the company?
Business apps, BIZNESS apps.
So that's the one that you scaled to 10 million ARR?
Yeah.
That's crazy. And that was fully bootstrapped.
We had raised $100K from two local Chico. I went to Chico State. And I raised money from two local entrepreneurs. So I like to say it's bootstrap, but technically not zero,
Right.
but take it as you will.
And so now what I'm interested in learning is because, of course, I also use this opportunity since I get to speak with seasoned entrepreneurs to also learn and get lessons from my own startup. And we as well with my company Podsquiz, we reached this product market fit, and there was a huge growth at first, and then we also caught the AI wave and everything, and now it's kind of stagnating. We can feel it. We don't have the momentum we had once we had, because there's like tons of competition now, and people, they are not as excited about AI as before. So now the question is, okay, we are transitioning this from an indie project that went well to a company, and I feel that now it's completely different. Now there's not a lot of new features that we can add, but there's a lot of more work in marketing and I don't know, creating this, making this more stable, like a proper corporate. And my question is for you, what changed both in business apps and micro acquire or acquire? Like, what is the biggest change that happens when you go from the beginning, starting it's working, to okay, let's make this into a company?
I mean, really two things, and you got to make sure you get them right in order. The first one is a shift from thinking about product development and stuff like that, in my opinion, over to distribution. I used to tell my whole team that we're not a software company, we're a distribution company. So I kind of like ingrained that in my team's mind is we're a distribution company, because we were never selling directly to our end customer. I was saying we're a distribution. We're trying to partner with the biggest companies in the world to sell our product for us. And then so distribution mindset shift. And then also you need a team. Like, you can't do it all on your own. You just can't. There's too many decisions. There's too many things. Like, someone has to own marketing. Someone has to own sales. Someone has to own customer support. Someone has to own product development. Someone has to own even the boring stuff like payroll, HR, all that sort of stuff. Now, you can't get that all at once. So lucky for you, that's your job as founder until you can afford it. So I was talking to another founder yesterday, and we were just talking about, distribution strategies. But, I think, if we're talking specifically about, indie makers and people bootstrapping, is you need to focus on low cost marketing strategies to really win. You're never going to win against, let's say you're competing against like, I don't know, some VC backed company. They're going to be spending a lot on, paid marketing. They're going to have a huge content team, blah, 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 blah. And so you're at a disadvantage. So if you even do spin up some paid campaigns, you're going to be paying, your LTV to CAC ratio is going to be probably negative, because these larger companies can afford that longer customer payback period. For those that don't understand, maybe what I just said, hire VP of finance when you get a chance. But at one point, your business becomes, basically a giant mathematical spreadsheet. So, to kind of pull that back a little bit, what I would recommend doing is really model out your growth. So, how many website visitors do you get? And then how many of those website visitors convert into free trials? And how many of those free trials convert into paying customers? How long do those paying customers stay? So now you have your lifetime value of your customer. And so from there, you can understand how much can I pay to acquire one customer. And then other things you want to optimize, especially if you're bootstrapping. And this is one metric that I really focused on, was customer payback period. So for us to acquire let's call them, we call them resellers, which again, white label customers. It was about $300, and the product was $300 a month in order to be a reseller of our product. And so we were profitable from that customer on like day 28. Yeah. So the faster you're able to accelerate that, the better. So I highly recommend in the early days to have, annual subscriptions if you can. Because then you could just take that money, reinvest it back into growth. But in terms of like how I got the gears running or whatever at Business Apps was, again, no marketing budget, so ads, all that paid stuff is out of the question. So that leaves you with brand and storytelling, and I leveraged that. Back then, brand and storytelling was typically done through media, so PR,
Right.
TechCrunch, VentureBeat, New York Times, Wall Street Journal, Inc. magazine. We were covered in all of those magazines, and we leveraged a story, which was like small business versus big business. I'm always a fan of David versus Goliath stories.
Yeah. I see you did that with Acquire too, right? And I was following you and seeing, what is it like with TechCrunch? That you were like trying to start this little fight with them.
The ironic part is so business apps was a bootstrap business, and we were featured in TechCrunch 12 times. I was a guest writer and everything. I knew all the old writers really well, and they were great. And then when I launched Microacquire, now Acquire.com, they weren't covering bootstrap companies anymore. Like everyone was talking about these big financing rounds. And so that's where I found my David versus Goliath. And it really was something I believed in. It was like, hey, like let's kind of like give a more realistic view of entrepreneurship. Because I also kind of grew up reading TechCrunch. Like I thought it was because you get these stories way back in the day in like 2009, 2008, where it was like two people just made a prototype and stuff like that, and kind of you felt a little bit closer. Like they were just 2 steps ahead of you. And now a lot of the articles are like they're like 100 steps ahead of you. So it's not inspiring. It's more just news. And so it's just this interesting, blog. I would literally wake up and read it first thing every day. And then it's kind of shifted into more of a mainstream, glamorized view of entrepreneurship. So yeah, that was my David versus Goliath with Microacquire to start, which was, hey, you're not portraying a realistic example of entrepreneurship, in my opinion. Like, come on, let's see if we can change this. And they ended up starting covering bootstrap startups, which I thought was cool. But I guess if I had to kind of round out that thought, it's just stand for something, like really have like a message that people resonate with. I think another great example is Nike, in terms of how they think about customers. So Nike sells fucking shoes. There's some technology. I'm wearing Nikes right now. But what they do is they sell a goal, they sell a lifestyle, they sell a purpose. They celebrate athletes, and like they're a commodity business. They actually do have some like pretty nice, soul tech or whatever. But anyways, you can copy that, whatever. But my point is I think startups should think the same in terms of, sell a goal, sell a lifestyle, sell a different viewpoint of the world. And then if you can find a tribe or a community of people that also agree with you, that's a very, very powerful marketing strategy, because people, it taps into the emotions of people, and people buy with the emotional side of their brain.
And Acquire, what is it selling? Like, what was the idea? Was it like, okay, bootstrap matters? Like, was that the goal?
It was really just that's a great question. It was just a reflection of kind of my personal story, which was, I built, sold a SaaS business, and it wasn't for $100 million. Like, it was just a bootstrap business. The acquisition wasn't featured in the Wall Street Journal. No one gave a shit. But it was completely life-changing for me. So I think, to summarize what Acquire stands for to me, is you don't have to build $1 billion company to be successful as an entrepreneur. I think that's all people hear about in the headlines in terms of, what startups are doing well. And if you got to like 10 million revenue, well, that's cute. It's like, well, actually, that's a huge accomplishment. You should be proud of yourself, especially if you're out there without investors. And so I think just that was kind of the narrative that I still believe to this day.
And it ties up well to your story, right? Like, as a poorer kid looking to your rich friends and say like they have it all, and like, do you see bootstrappers a little bit like, do you identify yourself as bootstrapper? Like when you see okay, these are small people, they just want to build their little product and they are being overshadowed by these huge, companies. Is there some connection with your childhood?
I mean, maybe.
Maybe
Because
it's being a little bit too far-fetched, but I don't know, I saw this
well,
connection
no,
and
I
I
see
found
where
it
you're going. I
interesting.
mean, as a bootstrapper, you're an underdog,
Yeah,
and I love underdogs. I love underdog stories. I love people who are,
yeah,
trying to build against someone that like taking down a big incumbent or,
yeah,
competing with someone with more resources. I think it's just badass.
yeah.
So, um,
There is a
yeah,
connection a little bit, I guess,
yeah,
in
I'd
a
say
deeper
there's a
level.
connection, but probably not a huge one. But I mean, that's what
Mm.
bootstrapping is all about. I mean, you can't spend your way out of problems. You got to be like creative, and it builds this like,
Yeah,
again, this
exactly.
mental muscle of, resourcefulness. And I think those are just
Mm.
key traits of, successful
Mm.
entrepreneurs.
Yeah. When you said one of the things that you mentioned as a trick to go from a startup or starting business to a thriving one was to start delegating and creating a team. However, we see a lot of big indie makers, Peter Levels, Tony Dean, they do things by themselves. They try, okay, the least that they can hire, the better. Sometimes they hire one freelancer, something like this, but they try to keep it mostly to themselves, and they seem to do really, really well. How do you see this? The fact that they don't want to grow so much, they want to keep it, with 2, 3 people maximum.
I think it's badass, and I think it's super impressive too. I think it just kind of, really brings home like the point of like you can be successful in 20,000 different ways. There's no one like framework or pathway to be successful or to build a successful business. I do believe that, you know, I think those individuals probably could go farther with the team. But man, they're like living the dream. They like,
Right.
have high profit margins. They live in like, don't they live in like different countries and stuff like
Yeah,
that,
yeah, yeah, yeah.
So what they're
Mm-hmm.
doing is they're defining success themselves, and
Yeah,
that's
yeah.
that's a super cheesy quote, but it's so true. I think again, going back to how to succeed in entrepreneurship, it's just figure out a way to play the game in a way that you love. So I'm
Right.
more of a team person, and I love building teams. I love working with teams. But are they required to be successful? No. There's so many
Mm.
examples of that, and I think it's awesome.
Right. I've talked with them, and I've talked with Tony Dean multiple times, and I asked him exactly this, like, what is your goal? And one thing is kind of common among a lot of indie makers, which is they want the freedom. So they want the possibility to do whatever they want, to follow, to create new projects. But at the same time, they also want to conquer the world. There's always this part, as an entrepreneur, I think you always have this part. Like, I want to conquer the world. I want to do something bigger. I want to beat the VCs, right? Because I feel the same. There's a lot of pod squeeze like competitors. They are also VC backed. I think I want to conquer them. At the same time, I like my lifestyle now. So if that's what we want, like, and I think we are still figuring out a lot of how can we run bootstrap businesses. I guess the best way would be, okay, let's start delegating, and if that's the next step, how should we start? How should we start delegating? Should we hire someone to basically do tasks that we don't want to do? Should we hire someone to do tasks that we don't know how to do? What should be our first hire?
I think it depends on your personal strengths. Like for me, my first hire was just helping out with just first it was obviously engineering because I'm not an engineer, and then it was someone to just help with sales because I couldn't handle all sales, but I still led sales in terms of the tracking, the
Mm,
management, the training. And then I hired for customer support. And then, you start adding on the nice to haves, which are really needed to have, but, head of marketing. And then you get a component of operations that's usually needed within the company. So it just depends. I would say, write down the stuff that, you're really good at and the stuff that you're really bad at, you're going to have to do the stuff you're really bad at too. Like you're going to have to do sales, you're going to have to do marketing. But what that does is it's an exercise that can help you operate in what they call your zone of genius. So if you're really good at social marketing and engineering or something like that, like most indie hackers that I've seen are successful are, you can stay within that realm, but maybe you hate formal marketing where, you're doing some boring stuff like content marketing or going on podcasts or, whatever, maybe paid ad spend or something like that, or partnerships. Hire someone for that, but you still need to understand the role. So when you're bootstrapping, you cannot afford a mishire. A big mishire is a huge waste of resources that you just don't have. And so you need every hire to be accretive in terms of the revenue they deliver back to your business. And the biggest way to de-risk that hire is to be in their shoes. So what I mean by that is you need to be that marketer for a little bit. You need to do all the stuff that you may not like doing. So you understand kind of what works, what's not working, and then you hire someone with the strengths in the areas of marketing that are working. And then you're able to onboard that person a lot more. The number one thing you don't want to do when you first start delegating is, let's say you have a sales problem, but you don't know how to sell at all. And so you just hire this sales lady or guy that has a great sales resume, and you just put him in a seat and you say, hey, go sell my product. That fails like basically 100% of the time. You have to be able to, sell your product if you're going to, move into like a sales motion within your business.
Okay.
So I guess, when you say, what to delegate first, I would say the things that are holding you back the most and the things that you, dislike doing the most, so you can spend your time on more high impact items within the business, specifically ones that only you, the founder, can do, or only you as CEO can do. And then you can hire people that are better at the roles that you're not that great at.
I guess for engineering it's a bit different, right? Because there's no way for you to try to be an engineer for a little bit. Or is there?
for me, no.
Right, but you have to hire one, right?
Yeah. So crazy story, but I hired my first engineer off. So before business apps, I had a job board that connected mobile developers with businesses. So I had like a big insight into who was good and who had the best ratings. So I sold that job board and I hired that like a top mobile developer from the job board. So I had a little bit of because I saw him do some work and I saw like his reviews and stuff like that. And then I ended up hiring the majority of our engineering team off just straight up Upwork. I hired this guy named, I still remember his name, Raymond Chester. He was an individual in China. We only spoke like on Skype and stuff. And then I ended up hiring like 10 of his friends because I didn't know how to also assess the talent of other engineers. So I just said, hey, he was basically the CTO for a long time.
Yeah, I guess there's always a little bit of trust that you need to have, but that's something that I always get as well, that recommendations are always the best way, right? So you might not know anything about engineering, but you have a friend that you really trust that knows about engineering, and maybe he or she can, recommend you someone, and I guess that will reduce the chances of failure.
Yeah, I mean, today, like I know a little bit more in terms of, hiring engineers, but if that's where you're at, I mean, again, taking that basketball and just shooting it, you might have some bad hires, but if that's your only options, like,
there's no other way.
That's what you got to do.
I guess there's one more option that a lot of founders can have, and that's kind of a bridge for the other topic I want to speak about, which is to sell it, right? To sell their business. And I never thought that was even a possibility. Sometimes I've seen people selling businesses that were pre-revenue. They were making no money and they were able to sell it. And I thought, okay, that's cool. I always thought that if you were not able to make money, then, well, you just lost it. You just have to start something new. But I've met a lot of people that they were able to sell it. Of course, not for a lot, but, some money, which is good, at least to justify to your friends and family that, it wasn't all in vain. And that's something that the topic that I want to explore, because that's a possibility for a lot of makers. And I guess the first question that immediately comes to my head is how to evaluate your business, because a lot of people say, yeah, just 10x it or 5x it. Is it that simple to just get your ARR, multiply it by 5 and go sell it? Or are there like other
No.
other things involved?
No, evaluations are they're kind of a moving target. One of my favorite quotes, and this is probably how I think most about valuations, is your business is worth what someone will pay for it. Just simple as
Right.
that. And if you go to 10 different valuation quote unquote experts, you're going to get 10 different valuations. So it's specifically if you're pre-revenue. Pre-revenue, we kind of say it's like the wild, wild west on acquire.com, because like sometimes people build like some really novel technology, and if you just compare that to something else based on financial multiples, so it also depends on the buyer. So you have financial buyers, and financial buyers will purchase companies in a very specific mandate. It's usually something like they will not go over 1 to 3 times revenue, and they're typically looking for profitable businesses that fits within this box, and it's 4 to 6 times EBITDA or something like that, and they will not go outside of that. And the reason is their whole model as a private equity firm or a financial buyer, their goal is to see a return on that investment. So you kind of need to put your buyer's hat on. So I think the biggest mistake founders make when valuing their business is they don't think about how the buyer is going to value the business and how can they articulate a rational valuation to the buyer. Like, how did you get to that 5x number? How did you get to that 10x number? And if it's just like, oh well, I saw Bloom was acquired for 10x or something like that, that is the worst way to value your business, because Loom was doing hundreds of millions of dollars and it was growing, really fast year over year, and they sold to a strategic buyer. Your business is subscale, not growing, so there's so many different like variables like that, but using, outsized outlier returns to justify valuation is a great way to just kind of show buyers you're not serious. And also putting your buyer hat on again is, most buyers are looking at hundreds of businesses per day. So if you're priced even just a little outside of reality, you're missing out on a ton of different buyer potential interest.
Right.
So I guess the best way to think about valuations is, we recently did a webinar on valuations where I talk about how to get to a higher valuation, like how to maximize your valuation. And the real way to do that is you want to bring as many buyers to the table as possible. So sometimes that could mean pricing your startup initially lower than what you might think. But like that number that's in most founders' head at like 10x, that ain't real, So
that is never real. So that will never happen.
No, I used to think 10x was, just take revenue and multiply it by 10. So that's super simple. But what you want to do, there's a saying, if you have one buyer, you have no buyers, because you have no leverage. So if you're just waiting for a buyer to come acquire you, that rarely works and is a dumb strategy, in my opinion, because they'll just sit and watch, and so bring a bunch of buyers to the table, and then have a realistic valuation where it gets them interested. It fits within kind of their how they would value to startups that are like yours, and these are all things that we help with at acquire.com. And then what you're able to do is, if you get multiple offers, you run a good acquisition process. That's when you can bump up to higher multiples, because you have leverage. You're able to say, hey, buyer who came in at 3x, like you can get to 4.5x. We have a deal, and you can kind of like, that's how you run a competitive process. Is you need to have leverage, and then you also need to have multiple buyers to have that leverage to push the price up. And then also, one thing that I think a lot of founders don't think about too is, if you do sell for like 6, 7, 8, 9, 10x, that comes with a baggage of terms to de-risk the acquisition for the buyer, such as an earnout, usually some stock component, because it's such a high valuation. And with public companies trading at 6x forward ARR, you're going to get basically front loaded, like this thing better perform really well post acquisition.
Right. So they won't just give you the money and say, okay, thank you so much, bye bye. They'll be like, okay, you'll get this percentage of the money now, and then there's goals that you need, that the company needs to reach. Maybe you need to stay for a year or two. There will be a bunch of requirements that someone will need to follow to get a 10x valuation. Is that it?
Typically, yeah. Usually 4 years is if you're getting like a 10x valuation. Yeah. Like those guys at Loom, like they're going to go work at Atlassian for 4 years for sure.
Whoa. Which is a lot of times things that, founders, they don't want that, right? At least for me, I just want to be my own boss, right? And suddenly I still sell my company and then I need to, become someone else's employee. That sucks.
Yeah. I mean, well, using the Loom example, I mean, I'd take that. Like, like go work somewhere for...
really?
$1 billion. Yeah, bro. I mean, I got a family. I always say feed your family, not your ego. But with so when Business Apps was acquired, we had other buyers, interested, and we went with a pure financial buyer. And the reason for that is another part of acquisitions that a lot of founders don't, and we're kind of touching on it now, is the terms. So the terms that I went after and I demanded from, a PE firm was, because most strategic buyers won't agree to these terms. They will provide a higher valuation, but again, the higher valuation is justified by earn out. You got to come over. You got to, hit these targets. Blah blah blah. Here's some stock too, and invest over 4 years. I wanted a clean break. I wanted all cash on close. I wanted a stock purchase. I wanted them to purchase. We had $2 million cash on hand. I wanted them to purchase that for tax purposes. And I wanted quick due diligence. And and private equity, if you are able to, again, bring multiple buyers to the table, both strategic and financial, you can negotiate terms like that. Mm-hmm. And you might not get the highest valuation for terms like that, but what you're really giving up is, the way I thought about it was, okay, I can maybe push the price up like 20, 30, 40% maybe, which is significant. But what I'm really like, I'm actually paying for that with my time. I just want to like sell this business, move on. And since selling my first startup, I built a crypto protocol company, which was acquired. Got to do a bunch of, fun traveling and consulting, and then started acquire.com. So I just wanted to get out and build something new. I would quit day one if I had to go to a bigger company.
It's very interesting. Yeah. I think, being an entrepreneur is not about being connected to one product, right? I think it's a lifestyle. It's building multiple things. And what you just mentioned, so basically, this is really interesting, because in most of other businesses, let's say you want to buy a car, a house, whatever, you start with a higher valuation, and then you eventually go down. We are now trying to acquire a house or flat, and it's like this. You go to these websites and the listings are quite high, and then you go, okay, I'll give you this, and they're like, okay, I take it. And sometimes 30K less or something like this. And what you're telling me, it's different for companies. So with companies, you kind of write down what are your requirements. You say, like, I want this, I want money, I want to immediately exit, whatever, and then you start with you lowball your business, and you see, okay, let's bring people, let's bring let's attract the sharks, and then based on this, you start increasing the value, right?
Yeah. Yeah. The thing I think a lot of founders also don't understand is you're selling your business. You're selling it. So a big part of it's sales. You got to talk to people. You got to figure out what's like most important to them. Is it the product? Is it the revenue? Are they a strategic buyer? Are they a financial buyer? How are they going to fund it? How important is a transition plan? How aligned are you on, the future of the company? Are you flexible on terms? Like getting buyers like interested? Because again, they're just kind of, especially using acquire.com as, an example. Like we have thousands of listings. Thousands of listings where some are priced, low, some are priced really high, and we have tons of data on like basically the best way to run a process. And it is typically to price on the lower end. And then what you do is you run a really good process where you bring a lot of buyers to the table, get a lot of them interested. And then what you do is you also control the process. And what I mean by that is you provide something called a deal schedule. And so a deal schedule basically puts time frames around, okay, this is the last day for initial briefing calls, which is just like a first introductory call. And then I need verbal offers by, usually 2 to 3 weeks after that, because there's usually some due diligence in between, depending on the deal size. And then I need formal offers by this date. And what you're doing is you're creating urgency amongst buyers so they don't just kind of sit back. And so I think there's also a misconception with founders that you just price it here and then someone just goes, here you go. And then you're like, thanks. So you have to sell the business. You have to get on multiple calls with buyers. You have to really stress the value of the business. You have to point out also what's wrong with it, because bad things don't kill acquisitions, but surprises do. Right. And these are all things that we help with at acquire.com, because it's confusing as hell. I sold my first business and I was like, I don't know what the hell I'm doing. Yeah. That was a big part of me starting acquire.com, because I felt that founders were at such a information disadvantage when speaking with huge private equity firms. And how do you, what is due diligence? How do I survive this? What are the big red flags to make a deal blow up? Because the last thing you want to do is sign an LOI, tell your whole team that you're getting acquired, and then it falls through for some reason. Right. Yeah. There's ways to increase the chances of close. I could go on for days on this topic, but
that's very interesting. It's a whole world that we need to learn about. So tell me about the buyers. What do they want? I know that there are strategical buyers. There's in general, why are people looking to buy bootstrap businesses?
The short answer is typically the cap table is cleaner, so there's no approvals needed from investors. So once you raise venture capital, you'll typically have a series of approvals needed. So it can be, and if you raise it some crazy valuation, the business just isn't worth that. And so it makes it more difficult to bring, everybody together and be in agreement. Unless you're growing like crazy and you get a strategic buyer, or you're on the other end and things are just going bad and it's kind of like, we'll take whatever offer we can get. So bootstrap businesses have, great attributes that every buyer loves, which is, number one, great, typically niche products. Two, they're usually profitable. Three, they're very capital efficient. And those are probably the main three. I mean, and then you're able to make a decision on selling the business much easier, because it's your business. You can just say yes or no. Yeah. So in the case of business apps, my company, as an example, I didn't have any exit blocking rights or anything like that. And you're able to sell a business for $1, $2, $3, $4, $5, $10, $20 million, and it's a huge success. In venture, that's unfortunately like a wah-wah. Yeah. And that's
True.
crazy.
If you sell something for $1 million as a bootstrapper, is crazy. You build something that now was sold by $1 million, because most of the money will also go to the solo fund or something like this.
And those are the people that inspire me. They really are. I think it's amazing. I think even 10, 20, 50, whatever. If you live in, other countries and you sell for $25K or $50K, and we've had situations like this where they sell for $250,000 or something like that. That's life-changing in another country. Yeah.
Well, to be honest, for a lot of families, that's life-changing. It's maybe you can buy a house or something like this with this money. It's crazy. And sometimes you build it in a year, which is absurd,
And if I could get another point in too, of just kind of, what I believe in, why acquire.com is so important to just a startup ecosystem, is I think everybody, again, is drawn to such extremes in terms of what success really is. Why do you want money? What do you want to do with it? Do you want to buy a big house? Do you want to buy a bunch of cars and stuff? But what money, in my opinion, the best part of it is the ability to just not have to be stressed out all the time. Yeah. So you don't need a big house. You don't need a super fast car. You don't need a billion. Like, what are you gonna do with $1 billion if you like somehow get the way? Like, what? I mean, it'd be
Yeah,
cool. I hope one day I experience maybe. But I think there's just such a skewed perception of what success and entrepreneurship is, and really, I just think it's just the ability to control your time, financial
it's freedom.
stability,
Yeah,
not having to have some job you hate. I think that's success in
yeah,
entrepreneurship. And we've just been drawn to, it's billions or bust. And,
yeah.
at acquire.com, we get to see this little tail end of just, people building these really simple businesses, almost to the point where it makes me question. I'm like, what the hell am I doing? Like,
Yeah.
these people are really like doing it right. And they're selling businesses for like 1, 2, 3, 4, 5 million or 500K or 50K. And it's super
Mm.
meaningful to them. And I think that's
Yeah.
awesome.
Yeah, definitely. I think that's what I love about bootstrapping is the fact that our priority mostly is freedom and is our well-being and then growth, which is like normally for VC-backed companies the opposite. It's like growth and then the well-being. So that's something that I really appreciate about bootstrapping, and that's why I more and more I'm in love with this way of doing business and this way of entrepreneurship. Um, so the buyers, I understand now why would they invest in a bootstrap business. It's basically are simpler, easier to manage. They have less expenses and everything. But then what do they do with these businesses? Like, do they try to plug it in their distribution channels and make more money out of it? Do they use it for raise whatever, like try new markets, try new technology? Like, why do buyers want to acquire business in general?
Yeah. So financial buyers, pretty simple cash flow. They don't care
Okay.
what your business does. Like, they just, if it's profitable, churn is low, that recurring revenue is reliable,
Yeah.
you're gonna have a ton of buyers. Immense about, like, you'll have like 200 NDAs on acquire.com if you price correctly and you have a profitable SaaS business. Strategic buyers are typically looking for a product that can help, or a team that can help them enter a market they may be falling
Mm.
behind in, or where they just see huge opportunity and they want to get again a head start. So, or they just want to add this additional product to their product suite because they have similar customers that would buy this product. So cross selling. So it really kind of falls into those two buckets. Financial buyers are typically the most
Mm.
common. And the reason financial buyers are the most common is because all they do all day is buy companies. Like, the private equity firm that bought my company acquires a multi-million-dollar startup every single week. Every week.
Really?
Yes, every week. They're a
Wow.
multi-billion-dollar firm, ESW Capital, and they acquire startups every week. And so when you're in the business of
And
buying
so, and what do they
businesses,
do with them? So they have like a small team that then will take over and just keep that recurrent MRR,
yeah,
the
it depends
recurrent
on the
revenue.
firm. Some will cross sell products. So they'll basically, like, Constellation Software is probably a good example where they just buy really, really niche vertical
Mm.
SaaS, like CRM for dentists that makes 2 million a year, like 3, 4, something like that. They love businesses like that. And then you also have Andrew Wilkinson's firm, Tiny Capital. His model is more of a private equity, like holding co model. I don't have like the exact details on it, but he just buys and holds. He just buys really simple, profitable businesses and holds them. And
But
then
it
you
needs a
have,
team. It needs a team to somehow maintain it, make sure it works, do some user support, I guess,
yeah.
right?
So typically, multiples get and valuations increase substantially once your business is at scale. What I mean by that is, you're creating enough profit or generating enough profit to where the new owner of the business can use the profitability of what the business is generating to hire a new operator if the founder is going to leave.
That's smart. That's a very interesting, investment. A lot of people say, going back to the book, The Rich Dad Poor Dad, they say like, yeah, buy a house, buy a flat, rent it out. That's the best way to get, some nice passive or close to passive income. But this is another way, something that is somehow it's certain, it's already making money, uh, and you can just hire someone to maintain it with the money it's generating, and then the rest, it's it's an asset.
Yeah, I mean, it's kind of like there's a simple way analogy to think about it. Most startup founders are going after like a big pile of cash. You know what I mean? Like they're trying to get that exit, like where they have all the money all at once. All of a sudden you're broke, and it's like boop.
Yeah,
you have a bunch of money now. Financial buyers specifically, they're creating a river of cash flow. So they're buying a bunch of different businesses where their investment thesis is basically to get a return on that investment over typically 3 to 5 years, depending on if they're able to grow the business or they're just maintaining the business. And they're just creating a river of cash that comes in every month from all the profitable businesses. So there's a lot of analogies to this strategy that I always think that are comparable to real estate, where you have a bunch of condos and people are paying you rent every month. And that money is kind of guaranteed.
Yeah.
I think it's probably a little bit more risky with software because you can get disrupted and stuff all the time. But that's the thought process. And there's been some very, very successful organizations, people that have been doing, even on the small scale too. On a small scale, meaning like buying companies generating 50K a year in revenue or profitability or 20K and rolling up. And this is where kind of micro private equity has emerged. And that's been really fun to watch as well. And even other entrepreneurs too. Like I've seen a lot of indie hackers
buying.
I feel like indie hackers is like this new term I've been hearing. I'm not hip with the terms. I thought it was just bootstrappers.
It's the same. Yeah, I would say.
Yeah. Anyways, I've seen a lot of bootstrappers, indie hackers also buy products, and then focus on those, and then they're focusing on sales, marketing, distribution. And so that could be an opportunity for other, small developers or just entrepreneurs. They don't have a fund, they don't have an idea, but they know marketing, sales, and maybe they have some sort of audience or podcast or some way to get in front of customers.
Okay, let's take a quick example. So let's say PodSqueeze. PodSqueeze is generating 150K ARR, and it's in the podcasting area. And let's say that we want to consider selling it. What should be like? What do you think people would ask? What do you think could be like our main? PodSqueeze, by the way, is a software for podcasters, like to help using AI to repurpose their content and so on. I don't know if it was your company. Of course, listing in acquire.com would be, I guess, your first step. But besides that, like, what would you do? Like, what could I expect?
What's the profitability margin?
It's about 80%.
80%. So we're thinking like 130K a year is profit. Yeah, I mean, I would list that. Probably at like 6x net profit, which would bring you to, not very good at math. I don't know, like 800,000 or something like that. And then from there, start getting feedback from buyers. So you go live on acquire.com, and typically you'll see a rush of buyers coming in. And I always say you want to treat every buyer like they're the buyer until they're not. There's this weird thing where people are like, oh, I don't want people stealing like my idea and stuff. And my view on that is if someone could just like, learn a little bit about your business and then copy you and then out execute you and beat you, like you don't have a defensible business.
Right.
So, focus on defensibility, but be open with buyers. Like, don't be like a closed book and like hide, obviously don't give away like, your most, like your code access to your code base or something like that. But you need to be open with buyers. And I guess you want to go in with the thought process of your job is to de-risk the acquisition for the buyer. And so that comes in a few parts. One is being responsive. So I say being responsive because when you're in a sales process, the last thing a buyer wants to do is deal with someone that takes like a week for questions, is late to calls and doesn't have their stuff together. It's annoying. Because that's what due diligence is going to be like. So I put, as a buyer, I'm also investing a ton of my time, legal resources. I'm going to be due diligencing, the code base with you. Like we're going on
a journey
like
together.
there's a saying, it's kind of like a reverse. It's like a reverse marriage. It's like you get married, and then the plan is to get divorced, and that's when you. Another terrible analogy, but so you want to be, like open to hearing buyers out. Like, hey, how would you value this? Like, I know I'm here, but like, I'm open to entertaining, all offers. Like, we'll consider it, and I've really enjoyed my conversation with you. And then, always try to get another call. Say, hey, would it make sense, to have another call a week from now? Let you kind of think about this, go through the additional materials. And then you take the call and you just move it over a week. It's called book a meeting from a meeting. It's a little trick we do in sales. So you keep that conversation going so you can keep momentum with the buyer. And you do this with every buyer that you speak to. And then even before you go live, I skipped this part, is preparation. So have like a clean P&L, have like a list of common questions available, have like marketing materials, record like a Loom video of yourself introducing, like, hey, this is Tiago, and I'm looking to sell this business. Here's kind of like the awesome stuff about it. Here's some things that we've tried that haven't worked. This is why we're selling it. Looking forward to speaking with you. Just like a brief introduction video that you can send to people in a message, which really will increase your people sign NDAs, but not all of them will hop on a call. Right. So it's just like a numbers game, but you need to be prepared, and you need to be direct, and you need to sell the business. And if you do all those things correctly, buyers get interested. They see that you're, serious about selling the business at a reasonable price. You start to get offers. From there, you can negotiate up based on terms, evaluation, whichever is most important for you. And then you go through the fun part of due diligence, which is actually kind of like hell. It's like telling your best friend everything you've done bad in life. And then hopefully if you do all that correctly, you get acquired.
It's cool. And I'm surprised with the 6x evaluation. I would assume that we would have to start a bit lower, 3, 4, something like this, for a company like PodSwiss. But of course that I didn't give you enough information to
without, there's things other like churn, growth rate. If those numbers are high, you can definitely command a higher multiple. So those things can definitely be factored into. But I think the biggest misconception that a lot of founders have is, buyers are valuing you on revenue when they're really valuing you on your profitability margin. So that's the key number, is how profitable is your business? Because if your business is, say, at break even, or if it's losing money, it's really hard to sell that business. You need to tell like a growth story, or ideally you should make cuts and get it to profitability before bringing it to market. If it's at break even, the first thing a buyer is going to do when they buy the business is they're going to find a way to make it profitable. So they can make it more capital efficient and start reallocating resources to areas that they feel will, put the business on a better trajectory. So profit, and this is a big shift. So in 2011, we were seeing businesses sell for wild multiples. It was super fun in those days. But the name of the game today is, buyers are looking for, profitability and capital efficiency over everything. So
the 80% number,
that's probably where
is good. It's a good number. 80% profitability is good.
It's really good. The only sort of, also understanding, red flags for buyers or things that might scare away buyers is, you're at that 80% margin because you don't have a lot of team members. So if your whole team leaves, they're going to have to hire people back, and that's going to drag that profitability margin down.
Yeah.
So addressing those things and talking about that, like, are you going to still be involved in the business? Who's going to be running it? Because it's really, really difficult to, buy a business with essentially 0 people coming on for at least a transition period of 3 to 6 months.
Got it. Yeah, very interesting. I feel that I've learned a lot about this new world of selling a business. And as a last question, also because I kind of forgot to ask you this, but I think it's really interesting. You are a branding guy. You've done amazing things with with the David and Goliath, going against TechCrunch, and as well what you've done with the guy from Silicon Valley, the Tres Comas.
That's
Russ Hammond. Sorry. that was super fun. I was like always watching those videos. And this is really cool, but at the same time, it's probably a big investment, to get these high personalities to do a cameo. And my question, and that's also like where my co-founder and I are always discussing, which is like, how can you measure branding, right? So it's really easy to measure a marketing act when you get clients, because you can see, okay, we did this, we got this amount of clients, so this is our return on investment. But when you do something branding wise, like creating a story like the David and Goliath you did, or get influencers to do cameos and stuff like that, or going to conferences, how do you measure this? How do you measure the branding? Do you have like a technique, a framework to do that?
I mean, there is one way to actually kind of get close to it, which is if you track down how many people Google search your company name.
Okay.
So if you, like, we used to measure, the growth of people searching microacquire. So that's one way. But I mean, word of mouth is the best form of marketing. So you're bringing up campaigns that, I don't know, like direct, ROI attribution, but you remember them. And we haven't put out a Russ Hanneman video in over a year.
That's true.
So stuff
how
like
do you
that,
measure this?
if you can really...
like, that's true. It works. But again, how can you justify this? How do you know how much to invest in this kind of videos, this kind of, marketing, if you cannot like objectively measure the impact that this has in your business?
I don't think everything needs to be completely measured, especially in marketing. In my opinion, the best marketing is a marketing that doesn't feel like marketing. Like those Russ Hanneman videos are marketing videos, but they don't feel like it. Like you watch them, they're funny, they're kind of crude in a way, there's some swear words in there, but they evoke an emotion out of a person, whether that's laughter or they educate them. There's a ton of different ways to think about this too, is also just your time too. So how do you justify your time on something? Like, how do you justify this? And I think especially in the early days of a startup, the more you try to justify, like, I mean, there are some like clear areas you should have like clear ROI, like specifically Google ad spend, Facebook ads, stuff like that. You should know how much am I spending? How many customers am I getting back? Are these customers staying? Is this a profitable channel? But for some things like social or product announcements, or, I always view that your biggest competitor is customer attention. And so there's thousands of startups out there today, and there's probably, 2-3 startups that kind of do the same thing that your startup does. I just have to assume
it's many.
Same with mine,
a lot of
but
them,
I don't. But I don't view them as competitors. I view really just customer attention as today's biggest competitor, because there's so much noise in the world. So if you're able to break out and stand out, your paid campaigns will also perform better. You'll see a lot more just organic, more organic searches of your brand, also increase your SEO positions as well. So it's kind of like a highly connected, marketing strategy. But yeah, it is really hard to have a definitive sort of, we paid this for this sort of video or this campaign and it delivered XYZ. We'll have ballpark, but it's really hard with brand. And but at the end of the day, I think the most powerful thing with a brand is, getting people to trust your business and want to do business with you, because you made them feel something, you made them laugh, you educated them, you taught them something.
And it's super hard to measure.
And those things are just really hard to measure. Yeah, they're hard to measure.
But how do you decide, and how much can you spend in that? How do you decide how much can you spend in a Russ Hanneman? Like, how do you decide?
Good old Russ. Well, when I first used him, he was $500, and then he raised his rates to like 1,000 to 2,000, because I think other people started using him. And by our last video we did with him was I think like $5,000, and at that point we were kind of like, I think this is getting a little too pricey.
But why did you decide that? Like, it just feels like it's too much? Is it?
Well, I also just kind of felt like, well, number one, he's off Cameo, so we can't use him even if we wanted to. I hope he's got some new show coming out. But also after a certain time, I feel you always want to be reinventing your marketing strategy. You always want to be thinking of the new playbook. So what I saw was other startups starting to use Russ Hanneman. And then I go, okay, now let's start shifting over to. Have you seen like the New York Times like billboards that we use?
No, not yet.
So we found like a tricky way to basically, if you tweet about an acquisition, or we'll put you up on a billboard in Times Square.
I've seen it. Yes,
and, yeah, and so that will cost, and people will be like, dude, you're like wasting all this money, like blah blah blah. And I'm like, no, we're not. What we do is we basically work with an agency that can get an hour, or like, let's say a 30-minute slot on that billboard. And then we rotate like 50 tweets in that 30 minutes. And then we just snap pictures.
Yeah.
And so the real value isn't people walking around New York. People walking around New York are just like, what the hell is that? I don't know.
They have no idea.
But we take the picture. We take the picture, and then the total cost for 30 tweets. And then that goes back to kind of like, we want to celebrate acquisitions regardless of the size. And so we're able to do that in these fun, creative ways. And that's what gets people talking about your brand, is when you're marketing in ways it doesn't feel like marketing. You go, oh, that's cool.
Yeah.
Like, and you share it. And then when someone shares it, who knows where it's going to go. But those are my favorite marketing strategies, is ones that you're not copying someone else's playbook because everyone's using it. And the more people, there's a saying, marketers ruin everything, because we do. Like, rest in peace, cold email. Or just, LinkedIn DM. They still work.
We had a lot of success with it, to be honest.
Oh, well, dude, back in the day, we would load up like SalesLoft with, cold emails to out to agencies. Response rate was like 50%. 50%, because people haven't caught on yet. But my point is,
it's not 50%, but we
saturate.
I think like 40%, maybe now it's not the same, but like at least 30% of our users came from cold emails. It's crazy. It's like it worked really well for us.
Well, that's exceptional. Well, I could definitely tell you it would have worked way better 6, 7. My point is, over time, marketing channels, they get saturated, or it just becomes really obvious when it's marketing, and no one wants to be sold to. No one wants to be sold to is more my point.
Yeah, that's true. You need to hide it. So, that's a very good point. Like, you need to sell something, but hide it. You need to make it more organic, more natural. Isn't it? Like, if you can add humor into your marketing, that's chef's kiss. Because it just shows people like, hey, like, we're building a business, but like, we like to laugh too, and we're not taking ourselves too seriously. Right. And that's my favorite type of marketing, is when it's like funny and it's something that people are like, they engage with it more. And it's not just an ad, it's creative, it's fun. Those marketing campaigns, in my experience, are the funnest to work on, and they generally perform the highest, and people talk about them. You want people talking about your brand, and that's one of the hardest things to accomplish. But once you accomplish that, you get a word of mouth flywheel that's really hard to put back in the bottle once you get it right. Exactly. Really good point. Andrew, thank you so much for taking the time to speak with me and to speak with the wannabe entrepreneurs here in the podcast. It was really cool to have you here.
Yeah, thanks for having me, man.
And that's a wrap of my conversation with Andrew. I hope you learned as much as I did and have a better understanding now about the world of selling startups. If you want to know more about Andrew, make sure to follow him on Twitter. His handle is Gazdecki. I will also link it in the show notes below. And check out acquire.com. If you are a first-time listener of this podcast, I have a lot of other interviews with many indie makers or bootstrappers. So just go to my website, wannabe-entrepreneur.com, and click on podcast, and you'll see a lot of episodes. Some are interviews, some is just me narrating my own indie journey. That's all for now. I hope you enjoyed it. If you did, please share this with all your indie maker friends, and see you next time.